What's good? I'll tell you what's not good. Fannie Mae and Freddie Mac just adjusted for inflation, and today we're going to talk about loan level price adjustments, LLPAs, and more importantly, we are going to answer the question that everybody's been asking. Are those with a high credit score, typically around 740 or above, and putting down a sizable down payment, typically around 20%, being penalized for having a good credit score? Well, we are about to answer that, but before we do, I need to introduce you to today's sponsor. Just kidding. I'm Kristopher Moody. I'm a local real estate professional out of Temecula, California. And I know this is just my second video, but I feel that's even more of a reason to subscribe to my channel. So if you did like my first video even just a little bit, and you find yourself liking this video just a little bit more than that first video, I promise you, I'm gonna continue putting in the reps to make sure that my perspective is delivered in a clear, concise, and easily understood way. That way these videos are not only informative, but also entertaining. So without any more delays, let's talk about loan level price adjustments. So what are loan level price adjustments? Well, LLPAs are adjustable fees that are tied to government-backed mortgages to help lenders mitigate risk. And these fees adjust accordingly to the risk profile of the borrower. But before we get too far into what LLPAs are, let's talk about why they even exist. So you can probably remember the Great Recession back in 2008. And that recession was brought upon us by the collapse of the mortgage industry. And during the collapse, there were a ton of government-backed loans going bad, or AKA belly up. And through that, the two major players in the mortgage industry, Fannie Mae and Freddie Mac, were losing money quickly. And they found that they were undercapitalized and couldn't really support the industry. So they knew that they needed to do something to recapitalize. That way, the mortgage industry could continue to operate. They knew that they wanted to implement some kind of fee to be charged to borrowers, but they knew that putting out a blanket fee that would basically hit all borrowers would be detrimental to the industry. And so what they came up with was the loan level price adjustment matrix. So let's take a look at the matrix that was introduced back in 2008. Now, on the left-hand side, we have the credit scores, and on the top, we have the loan-to-value range or loan-to-value ratio. So essentially, you have low to high credit scores going from 620 all the way up to 740 and above. And then on the top, you have loans that were financed, typically putting 40% down all the way down to 3% down. The profiles that we're typically talking about are individuals with a credit score of 740 and individuals with a credit score of 639. So if we look at the typical home buyer who has a 740 credit score and is putting 20% down, they were paying 0.25% in fees. Now, when we look at the other profile of a borrower that has a 639 credit score, and they are typically putting around 5% down, and these borrowers are paying 3.5%. So as we can see, when this was initially implemented, the fees that were being charged to borrowers went up or down based on their creditworthiness as well as the size of their down payment. Now, what changed on May 1st, 2023? So let's take a look. Now, there's three things that stood out to me when I first take a look at this chart. The first thing is the credit scores on the left-hand side. We had a little bit of contraction on the lower end and a little bit of expansion on the upper end. And when we look at the top, our loan-to-value range, we had, again, a little bit of expansion at the upper end and a little bit of contraction at the lower end. And in my honest opinion, the reason why I feel like they contracted on the lower ends and expanded on the upper ends is because there are not really many people being approved for home loan purchases at that lower end. And there are, of course, more people being approved for home loans at the upper end. The second thing that I notice is that we kind of have more of a bell curve distribution of the higher rates. Now, we see higher rates in the middle than we had previously, and we see lower rates on the ends. Not necessarily lower than all the other rates, but just lower from where they were. And so now we have more of a bell curve distribution, which it's isolating higher rates for the majority of people that are borrowing money to buy homes. And according to Bankrate, the average credit score for people actually taking out mortgages is 768. So we absolutely have more people that are going to be subject to higher fees. And what is this doing? This is basically going straight back into supporting the operation of Fannie Mae and Freddie Mac. And I feel that the Fed did this for one of two reasons, or maybe a little bit of both. The first being an adjustment for inflation, right? Everyone's seen rising costs in terms of their operation over the last few years. And they've also seen rising costs in labor, which obviously is another cost of the operations. So we've had increasing costs, which have not changed since 2008 for Fannie Mae and Freddie Mac. So yes, there may have been more or less home purchases. Values may have gone up or down based on whatever the scenario was. But essentially, they're trying to leverage this program to pad their top line to get more revenue. And the second reason I feel that they could have made these changes is because they are potentially preparing for the worst. We're currently experiencing a huge slowdown in the market, and we potentially have a recession ahead of us. So like any business, they're trying to plan and potentially brace for impact. So to summarize what's going on with the adjustments that were made to the loan level price adjustment matrix, we do have a higher concentration of buyers, or where the majority of buyers land, paying higher fees. And we do have people on the outsides paying lower fees. And more specifically, if you look at how this is being masked, it's being shown as a program that's improving affordability of housing. Now, I don't necessarily think that's the case. I still think that this is a way for Fannie Mae and Freddie Mac to improve their revenues from fees. Because if we look at the financial products that are being leveraged by less qualified buyers, most of them are leveraging FHA, VA, or USDA. And guess what? None of those are government-backed mortgages. And so there's no money going to Fannie Mae and Freddie Mac. So cutting these fees can make a conventional loan a little bit more attractive for a less qualified home buyer. So in my opinion, the whole fee schedule update is all driven by one thing, and that is to improve the operational revenue for Fannie Mae and Freddie Mac, for whether that is to cover some of their increasing costs Fannie Mae and Freddie Mac has seen over the last decade, or if they're potentially bracing for what's ahead of us. Now, you might be asking, is there a way to avoid these fees? And the answer is yes, but it really depends on what your goals and objectives are. Because going with other loan products is going to also come with additional fees and insurances that are going to potentially cost more than going with a conventional loan. And so even though fees have gone up for more qualified home buyers who are also putting a substantial amount of money down on their home, I don't think the other funding options are going to be leveraged as heavily as conventional loans. Yes, the fees have gone up. Yes, the fees have gone down for less qualified buyers, but in the end, the more qualified home buyer is still going to pay less fees overall just because their risk profile is lower than that of a less qualified home buyer who's not putting a lot of money down. So I know there's been a lot of noise going around about this topic, and I know this is probably the first time you're ever hearing this perspective, and that is exactly why I'm here. No one's talking about the real reasons why Fannie Mae and Freddie Mac and the Fed made these changes to the loan level price adjustments matrix. Yes, it is potentially making loans more affordable for less qualified home buyers, but essentially that's just a mask. What the real objective is to increase the revenue driven from these fees. So that's all that I have for you on LLPA's loan level price adjustments. I really hope you enjoyed this video and you found it extremely valuable. If you have anyone that has questions about LLPAs, please feel free to share this video with them. Also, for any more updates and new content that's coming, please remember to subscribe. And if you ever have any questions regarding real estate finance, please don't hesitate to reach out either on Instagram, Facebook, or here on YouTube. That's all for today. Thank you again for coming, and as always, keep smiling.